All right. Good afternoon, everybody. We're going to go ahead and get started. For those of you that don't know me, my name is Ryan Melliker. I am the president and co-founder of Lodging Analytics Research and Consulting, or LARC for short, as we like to call it. And before we jump into today's webinar, I just want to go through a couple quick housekeeping items. Number one is this webinar is being recorded. We will have the recording on our website, hopefully later today, if not by tomorrow. So if you have to hop off for one reason or another, don't worry, you can still catch the rest of it just by logging on to larkanalytics.com and going to our press releases and webinars page, and you can pull up the webinar right there. Second thing that I will tell you is that you will be receiving a slide presentation, the slide deck. Those of you that have logged into the webinar, we will send that out later today after the webinar, so you don't need to ask for it. It's going to come. I know somebody's going to ask us for it anyway. But those of you that are here now and paying attention, hopefully you realize that you don't need to ask for it. We're going to send it out anyway. And the last thing that I will say is that we are going to have a Q&A period at the end of the presentation. Happy to stick around and answer as many questions as I can. If for whatever reason we don't get to your questions, go ahead and shoot us an email at information@larkanalytics.com or my email, ryan.melliker@larkanalytics.com, and we'll try to respond accordingly. To throw a question in on the webinar, you probably know it's on the taskbar. There is a Q&A option. You can go ahead and throw in a question. That being said, I'm going to actually hide my video and jump right into the presentation here. Maybe I'm not hiding my video. Okay. That being said, let's go ahead and jump in. So our report, our presentation here today has kind of 6 core focus points. I'm going to touch a little bit on kind of how things unfolded throughout 2024, spend most of my time on kind of number 2 here, the economic outlook, that then translates into 3 and 4, and then we'll touch on some market highlights, and then we'll dig into one of those markets specifically. That being said, let's go through 2024, because 2024 is kind of fascinating, really, in just that there weren't, if you look at the data, it's like, oh, there really aren't a lot of trends here, right? You know, RevPAR overall was up 1.8% in 2024, driven by effectively all ADR with occupancy roughly flat. But what was kind of fascinating is the first quarter RevPAR was only up 0.1%, then 2Q was up 2.4, then 3Q was up 0.9, then 4Q was up 3.6. And there's a lot of noise in those numbers that were driving those things. So first quarter had the Easter calendar shift that negatively impacted those metrics. Second quarter had a positive impact from the Easter calendar shift. It also had the benefit of the solar eclipse in April. Third quarter then had some really soft results, and we think that was driven by 2 core components. Number one was with the general election in November, there's a lot of uncertainty and a lot of wait and see. So a lot of bookings didn't really materialize in the third quarter that you might have thought of, as they waited to see how things would unfold in the general election. This is pretty typical during a general election year across the U.S. The second thing was the leisure trends came in really, really soft. The U.S. consumer was really soft. July was kind of the low point in 2024 for the U.S. consumer, and that certainly showed up in our leisure demand dynamics throughout the third quarter. And the fourth quarter bounced back really, really strong. And what was driving that big shift positive? Well, one factor was real simply the swift resolution of the general election across the U.S. It wasn't something that was kept in limbo for weeks or months. That helped a level of certainty. And the second thing was we had a lot of positive impact from natural disasters. And I don't never want to say positive related to natural disasters, but from a hotel industry perspective, there was a lot of demand from displaced residents and a lot of demand from relief efforts across Florida, Texas, and the Southeast that really buoyed some of those numbers in the fourth quarter. So that's kind of, as we looked at as 2024, kind of how things unfolded. It wasn't like, you know, these numbers obviously kind of don't point to a specific trend, but if you kind of pull out the noise, you see a little bit more clarity. Now that's nationally, but if we go down to the market level looks very different. As we all know, hotels operate on a market basis, even a street corner by street corner basis. National metrics can be helpful, but we really have to understand what's going on in our individual markets. And when you look at some of the data here, what you basically see is, oh boy, there was real outperformance by some markets and real underperformance by others. Houston, obviously, a huge winner related to some of the relief efforts following Hurricane Beryl in the fourth quarter. And then Maui, obviously, a big underperformer tied to the wildfires a year earlier and the lack of demand that those wildfires translated into in 2024 for Maui. But other markets also performed really well, and other markets performed really poorly. It's not specific to natural disasters, and understanding the drivers of your market are obviously key, and hopefully will help you all do that to an extent today. That being said, moving beyond the top line, RevPAR growth obviously was relatively muted, with wage growth pretty high at 3.9% year over year last year. That translated into hotel EBITDA that was down about 2%. Interestingly, what happened in 2024, if you think about kind of where sentiment was from an economic perspective as we started 2024 and went through 2024, it shifted and gradually got more and more and more positive. Entering 2024, there was concern, are we going to have a soft landing? Is there going to be a recession? By mid-2024, oh, the soft landing is here. Recession's off the table. Things are looking good. By the end of 2024, oh, the Trump administration is going to boost economic growth. Things are going to be great. Stock market's at all-time highs. Everything's hunky-dory. And that outlook progression for economic growth that translated throughout the course of the year shows up in cash flow growth in terms of forecasts over the next 5 years for the hotel industry. And that drove asset values higher. Because at the end of the day, asset values today are based on the forward outlook for cash flow growth. And as that forward outlook improved as we went through the year, it also that drove values slightly higher, even though in-place cash flows were actually declining. Then let's take a look at kind of the economic outlook. And I think this, like I said, I'm going to spend most of my time here because I think this is kind of the 800-pound gorilla in the room today. We're going to focus on this from 4 components here. The first 3 are tied to the core demand segments, corporate transient, group, and leisure. And then the fourth one is going to be tied to the new Trump administration, some of the policies that are being put in place and the implications of them for the hotel industry, because I think they're very relevant, and we want to be mindful of kind of what's top of mind for everybody today. So that being said, when we think about return to office, and corporate transient, return to office is a big factor for corporate transient demand. Why is return to office such a big factor or office utilization for corporate transient demand? It's real simple. If people are in the office, corporate travelers are going to go visit those people in the office. If they're not in the office, they're less inclined to go visit those people in the office. There's a reason why TSA throughput volumes have been at historic records over the past couple of years, but our corporate demand levels have not been. It's real simple. It's the reality is people were cutting those trips short. They're doing day trips, or instead of 2 nights, it's 1 night. Instead of 3 nights, it's 2 nights, because they have fewer people to generally speak with in their offices. That being said, we see some headlines here on the screen. The reality is the headlines are always encouraging, but those headlines are unfortunately something that we've been seeing for years, and it hasn't necessarily translated into any meaningful shift in office utilization or return to office. If you look at data from Castle Systems, and Castle Systems by no means is the end-all be-all when it comes to office utilization, but it is helpful to gauge how some things are moving. And if you look at this data, and this is kind of a murky chart that they like to share, it kind of walks through top 10 markets and 10 market average over time of where office utilization is relative to what they think it was in 2019. And bottom line is things have been fairly stable. We have not seen an inflection point over the past couple of years. We've seen modest improvement if you look kind of the middle of these lines over the past couple of years. If we zoom in a little more granularly and you look at that top 10 average over the past few weeks, this is a rolling 4-week average, try to smooth those numbers out. We have seen an uptick since the Trump administration took office. There is a modest uptick, but we're also again still hovering in that 50 to 53% range over the past few weeks. It's not a big uptick. It's incrementally positive, and that's great, and we like that. And that should be a tailwind for corporate transient demand, but it's not an inflection point either, which is something to be mindful of. It's just a continued ever so drift higher, similar to what we've been seeing over the past few quarters. To give you an idea, over the past few quarters, the US Flex Index, which is great data for return to office or office utilization levels, they survey 100,000 office locations, over 100 million employees. And they basically pointed to, hey, in the middle of 2024, on average, office employees were in the office a little less than 2.5 days a week, but by the fourth quarter, it was up to 2.78. So that's improvement, right? That improvement is coming because you're seeing kind of companies jumping from 2 days a week to 3 days a week and things like that. It's those modest expansions that are super helpful. We will probably continue to see that move higher throughout 2025. We certainly think we are seeing it move a little higher, as that Castle Systems data over the past few weeks kind of shows, which is encouraging, and it points to, hey, we're going to see a tailwind from office utilization expansion, but we are not seeing an inflection point where, oh, this is going to jump massively and have a huge positive. It's incrementally positive, which is good, in a way that is similar to last year. All positive. Now, that being said, there are some caveats to that. And one of the main caveats here is the reality that office utilization, unfortunately, is probably softest in some of the segments that have the most corporate transient demand. Technology, insurance, financial services, and professional services offer the most flexibility. They also tend to be the sectors that offer the most corporate transient demand. So that's a caveat. The other thing that's really important when you think about corporate transient demand as we look at 2025 is that there are two primary factors that have historically driven corporate transient demand across the U.S. hotel industry: corporate profits and the stock market. When corporate profits are higher, companies are more inclined to spend money. When stock prices are higher, companies are more inclined to go out and travel to generate sales to support the elevated multiple that their stocks are trading at, right? Well, we've been seeing years of positive corporate profit growth, but the forecast for 2025 is for it to decrease 5.5%. That's after it was up 7.6% last year. Stock market, I think we all probably know what's been going on in the stock market. We've seen record year after record year after record year until the first quarter of this year, where we've seen a pretty big pullback. This week, obviously, has been a really big pullback. And I think the expectation going forward is that you're not going to see 2025 have the same type of year that we've seen in the past. And we certainly have seen it start off down. Those two factors are going to create headwinds for corporate transient demand growth, plain and simple. Now, they're going to create headwinds, but those headwinds are not insurmountable when you think about the fact that the stock market's still over 100% above where we were pre-pandemic, and corporate transient demand is not there. And corporate profits are 35% above where they were pre-pandemic. And again, corporate transient demand is not there. So while we think those are headwinds, they are not insurmountable headwinds. And frankly, we believe that the office utilization expansion or return to office growth will offset that and create positive corporate transient growth in 2025. It's going to be somewhat segment specific, market specific, sector specific. We just talked about some of the sectors that we see facing some challenges with it, but we will still continue to see expansion. Government's obviously a huge risk, and we'll talk about that in a little bit. Now let's move beyond corporate transient demand. Let's talk about group. As most of you probably know, LARC is the only forecaster out there that gets data for the largest convention centers across the US. We get data from the 30 largest convention centers directly from them. We incorporate that data in our forecasts, and we think it's really helpful and gives us great insight into where large groups are booking, especially across most of these major urban markets that comprise a vast majority of the hotel rooms across the US. And when you look at that data, obviously 2024 had a good year with convention bookings up 3%. 2025 is looking to be slightly better right now. Bookings are up 4% year over year. 2026 is even stronger. So we've got some pretty positive dynamics this year and next year with group demand, especially large conventions. One of the reasons for that is the dynamic. Well, if people aren't in the office as much, they're traveling via group. You're getting your teams together more frequently at conferences and conventions. That's positive for, obviously for the industry. It's certainly positive for pricing power across the industry because you shrink hotels by getting all these group rooms. Um, on the books that allows you to be more aggressive from a pricing perspective. But not every market is going to see those benefits this year. San Francisco is going to see the biggest benefit. Year over year, their group booking pace is up 69%. Massive number. That sounds amazing. It is amazing on a year over year basis. Still 35% below pre-pandemic levels. So it's one of those great. Should have a good year from a year over year growth perspective, but don't be expecting 2019 levels anytime soon. Denver's a really interesting one where the group booking pace is really strong, but from our understanding, the pricing of those bookings via the CVB came in light. So they basically lowballed price to get the bookings. The bookings are there, but ADR may not necessarily reflect that type of strength in Denver. And Orlando is also really strong, up 22% year over year. That number is likely to moderate as we go through the year because the CVB has told us they've basically sold out the capacity for 2025. So they're not going to get any more in the year for the year bookings. And they did get some of those last year. So as that moderate, so as the anniversary of that, you'll see some of that 20 plus 22% moderate a little bit as we go through the year. Still really good year for Orlando. And then you have some markets that are much softer. Atlanta having a tough year. Minneapolis going to have a soft year. Austin Convention Center is closing in a month. Going to have a big impact. So we look at all of that, gives you a sense, hey, this is good across the industry, but not every market is going to benefit from it. Some are going to benefit a lot more than the average. Others are going to benefit a lot less, or it's even going to be a headwind. Now let's shift from convention from group to leisure, because I think leisure is probably the 800-pound gorilla that we're going to spend a lot of time talking about. And this is a very complex dynamic. So generally speaking, when we look at leisure, we have positive data and we have negative data. The positive data, to give you an idea, this chart shows the Visa US spending index, their overall spending index and the discretionary spending index. And what I've done is I've smoothed it to a 3-month average. And if you look at that 3-month average, what you'll see if you focus on the dark line here, the spending index, it troughed on a 3-month average in the third quarter. Makes sense. That's when our hotel industry leisure data was really soft in the third quarter, right? And since then, we've been seeing things gradually increase, right? From a discretionary spending index, it troughed in July, and we've generally been seeing things move in the right direction, right? Now that's true, but that's a 3-month moving average. If you actually look at data in January and February, January retail sales declined 0.9%. The Visa spending index is positive in January, but then declined 2% in February. The discretionary spending index was flat in January and then declined 2% in February as well. So we have certainly seen some softness recently, but that softness is still well above where we were during the summer of last year. And I think that's kind of the key point that we would highlight about some of this. Now, whether that softness continues or gets worse remains to be seen. I think at the end of the day, what's driving that softness is a lot of the uncertainty being driven by current administration's economic policies, which we're going to talk about in a little bit. It's creating some unease in the stock market, creating some unease in the consumer, and that's weighing on overall consumer confidence, which is in turn impacting spending and the health of that U.S. consumer. Now, those are some data points. Bottom line is there's a lot of positive trends relative to where we were in the summer, but things are starting to shift in a negative light here, which is worth highlighting. When we look at the Deloitte Consumer Spending Intentions Index, this is an index that is more of a leading indicator a few months ahead of time. When you look at the leading indicator, if we focus on the total spending, it troughed, in May. Which makes sense. Geez, it's going to trough a few months before the Visa spending index troughs, which is actual data of spending, right? And it ticked up pretty nicely for several months in a row before it started to moderate, right? But it's still generally improving. The leisure spending index, on the flip side, came out pretty strong and has stayed pretty positive. Above zero means it's in expansion territory. So you're seeing year-on-year growth, which is encouraging and gives us hope that we're going to see stronger leisure dynamics, even if things are moderating a little bit from where they were a few months ago. We're still positive growth. That's the bottom line there. Makes us feel decent about some of those metrics. And then you get into this other data, and this is kind of fascinating to me. So this is personal savings rate versus spending on hotels and restaurants. So I know it sounds crazy, but believe it or not, when people save more, they spend less on things like hotel and restaurants. And when they save less, they spend more on things like hotels and restaurants. When there's a tremendous amount of economic uncertainty and consumers are wary, the job market is soft and they're uneasy, they tend to save more and spend less, right? Makes sense, except what the forecasts call for today are personal savings to actually decrease in 2025. And if the personal savings rate is going to decrease in 2025, that should be good for spending on food service and hotels. In fact, Moody's Analytics forecasts spending on restaurants, food service and restaurants to increase over 5% in 2025 on a year-over-year basis. That's an acceleration from around 4% a year earlier. That's positive for hotels, right? People are spending more. That's going to be good for our industry. So we actually see some of this as kind of, when you kind of push through the noise of what we're seeing in the media and quote the chaos that's ensuing with current fluctuations in economic policy. As you move past that, things actually don't look so bad. The question is, can we move past that, or is this chaos going to persist for an extended period of time? Another thing that's worth highlighting is the dynamic of international travel, foreign inbound arrivals versus U.S. citizen international departures. A couple things that we'll highlight about this, because I think it's an important topic. Number one is foreign inbound travel volumes were still down 8% below 2019 levels last year, but they were up 9% year over year. So we're seeing some improvement. International outbound travel volumes were up 21% versus 2019 levels last year, and they were also up 9% year over year. So bottom line here is we are seeing some dynamics where you're seeing positive improvement on both metrics, but really the strength has obviously come in foreign outbound arrivals, which probably makes a lot of sense. Shouldn't be too surprising, right? So the next thing that I'd highlight about this is, if you think about what that gap really means is in 2019, inbound arrivals to the US exceeded outbound departures by about 5 million travelers. It's a big number. And outbound arrivals but in 2024, outbound departures exceeded inbound arrivals by 13 million. It's an 18 million traveler gap that we've seen unfold over the past 5 years. And how do we get that to turn around? Now, the good news is inbound arrivals are now growing at the same pace as outbound departures. So that gap isn't widening in any meaningful way today. The challenge is it's also not narrowing, right? So what gets that to narrow? Well, the obvious answer to us is it's all about the strength of the dollar, right? The dollar has been incredibly strong. It is still incredibly strong. Over the past couple of years, economists have been forecasting the dollar to soften. Guess what? It hasn't really happened. And now today, the economists that we work with, Moody's Analytics, are forecasting the dollar to actually increase in 2025. After a few months ago, they were forecasting a material decrease. They've shifted all of that out. And now they're looking at the decrease in 2026. Who knows if that will really happen? So it makes it really hard to say, hey, this is the year that foreign inbound arrivals are going to really turn the corner and U.S. citizens are going to stay local. Now, the flip side of that is somewhat positive is that there's still a bit of pent-up demand for foreigners to come to the U.S. The challenge with that is, are they likely to do that in 2025 when 2026 is the World Cup, 2028 is the Summer Olympics, and the dollar is still elevated, or are they more inclined to wait a year or two? Remains to be seen. My guess is we're going to see some tailwinds from inbound foreign arrivals continuing to grow, but I'm not sure it's going to grow at a faster pace than we've seen outbound departures continue to grow as well. So what markets benefit the most? Well, this gives you a little bit of expo, which markets have the most exposure to foreign arrivals. You get the idea here. Obviously, there's a big gap between some markets and others. Shouldn't be too surprising. And then which ones are going to benefit the most? It's not just the ones that have the exposure, it's also the ones that have the most recovery left. So if you look at Honolulu over here, still 44% below pre-pandemic levels, LA 17% below, New York, Chicago, San Francisco 8, 9% below. Meanwhile, DC is 8% above, Dallas 14% above. So some of those markets have more recovery remaining than others do. And that's worth highlighting and understanding. Now, now the last thing I want to say about this is one of the other factors that can impact inbound foreign arrivals to the US is how welcome those foreigners feel in the US. And the current administration, to some extent makes people feel welcome. To other extent, it does not. And there's a lot of rhetoric in the media that can have implications on that. That's really worth highlighting. So as we think about that, it's just worth noting that hey, there are other factors here, and maybe the current administration isn't doing the hotel industry as much of a favor as we would hope it would when it comes to some of these things. But it's not just those. So as we think about kind of the current administration, I want to focus on three core policy initiatives that are really having a big impact on the U.S. economy and what we think on the hotel industry. So first is obviously the tariffs. The tariffs are the 800-pound gorilla in the room. Why are the tariffs a big deal? Well, the tariffs are a big deal for a couple of reasons. Number one, our current administration has effectively launched a trade war. The view from the current administration is there may be some short-term pain for some long-term gain, and we hope they're right about the long-term gain. We're not here to dispute that or question it. That's not my view. But in the short term, when we think about 2025 specifically, economists are generally projecting that a 10% tariff translates into 80 basis points of elevated inflation this year. And obviously, it's a drag on the US manufacturers and a drag on GDP growth. That's 10% tariffs. God knows over the past week, we've seen numbers get thrown out there by the administration over 100% for various different countries and various different materials and items. So it has been a whirlwind over the past, call it 3 or 4 weeks related to the tariffs in terms of what's actually going to be implemented. There is a ton of the current administration is basically negotiating in the press. And I understand that they are basically just trying to kind of get the best deal and get things settled for the U.S. over the long term. But in the short term, that creates a lot of chaos. It creates a lot of uncertainty, and that is heavily weighing on the stock market, the economic growth, job growth, inflation, all these things, which are certainly not good in the short term. And we're seeing it day in and day out. I mean, I put these numbers in this slide a few days ago, and I think they're already outdated. We'll continue to see things evolve. But bottom line is the expectation as these tariffs continue to take hold is that they are a headwind for economic growth and a headwind for and will translate into rising inflation. The hope is that things settle down a little bit. And as things settle down and these tariffs may not be permanent, maybe they're just, a month or so until we move past, Trump, the Trump administration gets what they're looking for in the negotiations and they feel better about them and things start to subside. That is the hope. If that happens, that's probably very good relative to expectations today. If it doesn't happen, remains to be seen what the longer lasting implications could ultimately be. But just worth noting on those things. Then the other big thing that the Trump administration is really focused on is immigration and deportations. One thing that I'll highlight about this is, and this is going to be the case, it's a general theme with the current administration, is it's important to pay attention not just to what they say, but what they do. Obviously, what they say can impact behavior, but what they do has a much bigger impact on some of the metrics that we focus closely on. So to give you an idea, obviously, Trump has talked about wanting to deport 15 to 20 million, undocumented immigrants across the industry. There's only an estimated 11 to 12 million, so that's kind of an interesting disparity, but cross that bridge when we get to it. What's kind of fascinating is that in his last term, he only deported about 300,000 per year. And in February of this year, he deported about 38,000 immigrants, which was 19,000 less than a year earlier under the Biden administration. So kind of interesting. Now, obviously, we do believe that the deportations are going to ramp up. It just hasn't been, the mass deportations haven't been as much of a focus as some other things up till now. I'm sure that will change. But the other side of this is that the rhetoric surrounding, the unwelcome nature of undocumented immigrants is going to translate into fewer of them coming across the border too. So why does all this matter, right? Well, believe it or not, if you lose 11 million undocumented immigrants, those are 11 million people across the US that go to work and spend money. The expectation is that, or the estimate by the American Immigration Council basically states that, if we got rid of all of our undocumented population, it would translate into about a reduction in US GDP of between 1.1 and 1.7 trillion dollars, 4.2 to 6.8%. It's pretty big number. We're not saying that's going to happen overnight. It's certainly not going to happen overnight, but this is a headwind to economic growth that needs to be mindful. And it's most severely a headwind in markets and places where there are more undocumented immigrants than California, Florida, and Texas. Now, how does this specifically pertain to the hotel industry? Well, the Center for Migration Studies, estimates that 1.1 million undocumented workers are employed in the hospitality sector, hotels and restaurants combined. So that's a big risk. So what happens if half of those people get deported? Well, that shrinks the labor force. Harder to find staff, which drives wages up, which isn't great for our industry in general. And obviously, it's going to be worse for those areas like California, Florida, and Texas, where you have more of them. The other industry that I think is going to be really impacted by this is the construction sector, which also relies heavily on undocumented workers. And a shortage of available workers there will drive construction costs up, will extend development timelines. That can be positive from a new supply perspective. Maybe supply growth becomes more muted than even we think it will be, because of these dynamics. But it's a negative when it comes to renovations and capex, and especially renovation disruption. So a project that you're going to go through your lobby, a lobby renovation or a PIP of some type that you thought was going to be, 3 to 6 months is now 6 to 12. And the disruption tied to that is then doubled, right? You have a much bigger issue tied to what the actual IRRs of those capex projects are, because of not only the cost of the construction, but now the extension of the timeline, which generates more disruption. So these are really important things to pay attention to as you're looking at some of those projects, as we move through 2025 and beyond. And the last thing I want to talk about with regards to the current administration is kind of the federal employee layoffs and return to office of federal employees. Here are some of the facts, and then obviously there's the nuance behind the facts and kind of what the administration is really trying to do. As of late February, there were about 30,000 federal workers had been given notice of termination on a federal workforce of about 2 million. I know about 13,000 more were added this week tied to the Department of Education. So we certainly are seeing more and more. It is happening. That being said, there's a tremendous amount of uncertainty tied to these layoffs. The viability of them is certainly in question. Several layoffs that have occurred, the jobs that were laid off have since been reposted, and in many cases, those people that were laid off have been rehired. So this dynamic of taking, for lack of a better analogy, the chainsaw as opposed to the scalpel is translating into probably more noise than is necessarily required. Now, the chainsaw may be the appropriate tool when you're trying to break something, right? At the end of the day, it seems like what the current administration is doing is trying to break the size of the federal government. That's one of the focal points that they have. They're doing it in an aggressive kind of break it and we'll put it back together later situation. And again, that's another dynamic where it creates probably more headwinds in the near term, but maybe gets to their goals in the long term. And that's aligned with what Trump has talked about recently, where there's maybe a little short-term pain for some long-term gain. And I think that that's part of what we're seeing here. Now, the other argument against all of this that's important to keep in mind is that the legality of these layoffs is certainly in question. Federal labor unions have filed lawsuits left and right against the Trump administration. You've had independent agencies come out saying that the Trump actions are illegal. You even had the Office of Special Counsel ask for a stay of terminations of federal employees. There's been a lot of different things going on, in terms of how legal all of this is. And to some extent, I think that part of this dynamic may be that the Trump administration is trying to do what it thinks is right, but also kind of knows that it can't really get there without, the judicial branch in support because of some of the unions, the contracts in place, all those types of things. So they either get the judicial support, the judicial branch's support, or they don't. Either way, they tried, and they can blame they can blame the justice they can blame the judicial system, or they can or they have success. Either way, they tried, and they feel like they've done what their constituents wanted them to do. The same thing can arguably be made for return to office, right? So there's a lot of talk about, oh, the federal government's forcing everybody back to the office, right? Guess what? According to the Office of Personnel Management, over half of all federal employees have telework flexibility built into their collective bargaining agreements. Half, right? Makes it pretty hard. Requiring those people to be back in the office is in direct violation. And you've had several lawsuits filed by the unions. You'd be very hard pressed to see those overturned. Additionally, the DOGE has terminated 748 office leases of about 10 million square feet. They also have plans to sell about 450 office buildings that are occupied by the federal government. Now, it doesn't mean to say that those office buildings will no longer be, won't have leases for use by federal agencies. But bottom line is they are shrinking the footprint of office space across the federal government, shrinking the footprint. But you're asking everybody to come back to the office doesn't really work if they have no office to go to. And I think that's kind of why you're seeing this being. The media is touting all of this, but in reality, you're not seeing that big movement, right? If you look at that Castle Systems data for Washington, D.C., we've seen an incremental tick up since Trump took office. Positive, but it's not an inflection point of, oh my God, we've seen 10, 20, 30% increase in office utilization over the past couple of months since Trump took office. It's been very marginal, just like everywhere else across the country, and I don't think you can expect to see that really change in any meaningful way without the judicial branch in being willing to rule in favor of the federal government and violate these collective bargaining agreements, which I just don't necessarily see happening anytime soon. That being said, we put all that together and you get kind of, for lack of a better term, relatively uninspired economic growth outlook for 2025. GDP growth is expected to decline from 2.8 to 2.3 this year. Job growth decline. Average unemployment rate tick up slightly. Inflation remain relatively elevated. Corporate profits turn negative. Consumer confidence turn negative. The strength of the US dollar continuing to expand, and the 10-year treasury yield ticking up. Oh, great. That doesn't sound great, right? No, it doesn't, right? Nothing sounds that good. However, when you think about kind of broad-based economic growth, one of the things that's really fascinating to us, and we spent a lot of time looking at this, is from 2000 to 2019, there was an incredibly strong relationship between real GDP growth and RevPAR growth, right? As GDP went up, RevPAR went up. As GDP went down, RevPAR went up. 71.2% R squared and a 50.7 or 71.2% correlation and a 50.7% R squared. That's a great relationship between 2000 and 2019. Then over the past 4 years, look at how that broke down. It dropped to a 54.2% correlation and 19.5% R squared. And now over the past 2 years, now granted, we have limited data points, over the past 2 years, that correlation has inverted it's a negative 26.7%, and an R squared of 7.1. So we can sit here and talk about how challenging the economic environment is, and how that's going to weigh on RevPAR growth in 2025. But the reality is, it hasn't necessarily had that direct relationship over the past couple of years. And the bigger question is, why is that the case? Why has there been a decoupling between RevPAR growth and economic growth across the industry? And the answer, I think, is just because the components of economic growth have varied. Right? We have seen softness in RevPAR growth when the components of economic growth haven't really supported hotel demand and pricing power and the consumer in general. And the flip side of that, we have seen strength in RevPAR growth when the components of GDP growth really did support that. And understanding which components they are is really, really important. And while we can look at it nationally, I think it's much more helpful to look at it on a local basis where each individual market is being driven by different factors, which is something that we try to do here at LARC to better understand those things. But on a national perspective, we think that some of the components tied to leisure, which are certainly turning, which certainly showed signs of turning leading into the past month or so, give us some confidence that leisure is going to be okay and RevPAR growth is going to actually accelerate this year, even while those other metrics start to decelerate. That being said, before we jump into our forecast, some of the assumptions that drive our forecast, the Fed's going to begin cutting rates in September, 25 basis points per quarter. Inflation will kind of pause where it is this year and then start to moderate again in 2026. The conflicts in the Middle East and Ukraine aren't going to escalate. And we do not, Moody's, who we rely on, does not forecast a near-term recession, but economic growth is going to be muted. So let's talk about our industry forecast. That's what people really care about, right? So when we think about the three demand segments, and I talked a little about this earlier, corporate transient, we think that there are modest tailwinds this year. We'll see slight growth in 2025 after decent growth in 2024, but ultimately going to hover around 10% below pre-pandemic levels as the segment that really doesn't recover back to pre-pandemic levels. Group, on the flip side, we've got strong growth this year. We think it will ultimately get to 10% above 2019 levels. Leisure transient kind of came out of the pandemic really strong, rallied high, has been waning ever since. We think this year we start to see things stabilize, and then we see modest growth. And from our view, stabilization in leisure is a win versus the headwinds we've seen the past couple of years from leisure. If it's no longer a headwind, that is a win. And that's exactly what we think is going to happen if we get corporate transient and group to continue to do what they've been doing. We look at supply. Supply growth is incredibly muted across the industry. We forecast 0.7% supply growth this year. That's ever so slightly tick up from where we were last year. Overall, we look at supply as incredibly benign, a little less than half of long-run averages over the next few years. And that number could even come down based on whether projects can actually get financing and get off the ground, given elevated construction costs and elevated financing costs relative to the past 15 years or so. Markets with the most supply growth you see here and markets with the least you see here. There's no one market that stands out as, oh my God, that's got a ton of supply growth and that's huge risk. In fact, across all of our coverage universe, there's no single market where supply growth is the reason why we are cautious for that market. There are markets that we think have higher supply growth. There are markets that we are cautious on, but we're not cautious on the market explicitly because of higher supply growth. Generally speaking, we don't see supply as an issue, which is a good thing for the industry, right? Now, here's our RevPAR model. We incorporate a bunch of different factors here. It has a 98.7% R squared. The dark blue line is the actuals as reported by STR or CoStar, seasonally adjusted. The light blue line is our model. We've built that model to basically estimate what RevPAR was historically, and then going forward, based on the forecast for these metrics, you can see how accurate that's been historically. Same thing for ADR here, a 98.9% R squared. And then you put it all together, and here's our forecast versus the other guys. At the end of the day, when you think about our forecast versus the other guys, we are the most bullish for RevPAR growth. We are the most bullish for ADR growth. We are the most conservative for occupancy growth. We think you're going to see the strong ADR and strong RevPAR growth fueled by the group dynamics, improving corporate, as well as leisure being less bad. And that's kind of the key point that we want to highlight here. Occupancy is still going to be soft this year. We're not talking about a lot of demand growth by any sense, given the macro backdrop that we just highlighted. But we do think that there can be pricing power, and we also believe that you're going to see some strength from RevPAR overall. And next year we see a little bit of a similar RevPAR growth, but kind of a occupancy recovering a little bit, and ADR moderating a little bit, but still positive. And overall, our numbers for next year are also the strongest across the industry for RevPAR growth. And then if we break it down by quarter, and this is where I think things are interesting, if we look at the first quarter of this year, we expect the first quarter to be the strongest quarter of the year. Why are we seeing close to 5% RevPAR growth in 2020 in the first quarter? Well, there's two core components. Number one is the Easter shift that will happen in the back half of March, which creates some pretty soft comps that should really help the U.S. industry overall. It doesn't help every market, but it's going to help a lot of them. And number two is we saw a lot of strength tied to pent-up demand from leading up to the general election that was unleashed in November and December and continue to get unleashed in January. We think that has helped the market as well. That is not something that we see as a long-term dynamic, but it is a tailwind in the first quarter, which is why RevPAR was up, I believe, over 4% in January. Second quarter then faces headwinds, right? Headwinds from two things. Number one is that Easter calendar shift I just talked about, as well as the comp of the solar eclipse in April. So we see softer growth there. The third quarter, we see positive growth in the third quarter, largely because 3Q last year was so negatively impacted by the soft leisure environment and the uncertainty leading into the general election. We think that creates nice tailwinds in the third quarter, which should lead to solid growth. Now, that being said, that's probably the quarter that we have the most risk. If we're going to be wrong, we're going to be wrong in the third quarter. But we feel pretty good about where that is today, based on those soft comps that we're seeing from last year that give us some confidence. And then the fourth quarter, we actually have a much softer view on, and that's largely tied to much more difficult comps, especially driven by the hurricane displacement impact in the Southeast and Houston, which will weigh on those numbers. And then if we look at it by price class of hotels, top end is going to really outperform. We've got 5% RevPAR growth at luxury and upper upscale, and then close to 2% in the middle tiers, and then 1% at the economy segment. What I will tell you is that, which is kind of interesting, is we actually do not see negative growth or flat growth at the low end, like we saw in 2024. We think things turn positive. Again, that's tied to that summer view of leisure being less bad in 2025 than it was in 2024. And that's going to create some softness or some tailwinds. That being said, it's nowhere near enough to offset the strength that you're seeing at the high end. And then relative to 2019 levels, the clear winner has been the luxury segment, and the loser has been economy, which has struggled to grow at the same pace as the other segments. While pretty much everything else, in 2025, we expect to be somewhere between 13 and 16% above 2019 levels. Now, why should you trust our forecast? I always say that I always think this is important. It's not just about what the numbers are, but why should you rely on our numbers, or why should you have confidence in our numbers? Because I think one of the things that I can only guarantee is every forecast is going to be wrong, right? But if you understand the process and what goes into it, you have a better sense of understanding whether you can value it and you find it helpful to you. So our approach is using only the best data providers, whether that's STR or CoStar for historical baseline results, economic forecasts from Moody's Analytics. We're the only forecaster out there incorporating the convention pacing data, which we think is really, really important. And you can see some of the other data that we put out. And as a result, it's translated into, fortunately, better forecasts. If you look at where our forecast was at the start of 2024 versus actual results for 2024, we missed RevPAR growth by 60 basis points, 0.6%. Everybody else was missed by between 1 and 2.2%. It's a big difference, right? We clearly outperformed in 2024. If you think 2024 was an anomaly, and this is nationally, on a national basis, it was not an anomaly. In 2021, we were the most accurate. In 2022, we were the most accurate. In 2023, we weren't. PwC was a little bit better than we were. But only us and PwC were within 1% of both occupancy and ADR growth. So we give them credit, but still, 3 of the past 4 years, we've had the best forecast, and we feel pretty good that we're kind of on an outlier this year. Everybody else is kind of in that 2% and below, and we're sitting north of 3 right now. And then at the market level, we've also been more accurate. If you look at our market forecasts across the 62 cities that we issue quarterly forecasts for, we've been more accurate. We were more accurate in 2024 across 70% of them, and by a wide margin. We were more accurate by 80 basis points in 13% of our markets. The other guys missed by over 5% more than we did. Those are pretty big numbers. We didn't have those dynamics anywhere. And it wasn't just in 2024. In 2022, we were more accurate by 70% of our markets. In 2023, we were more accurate in 70% of our markets. So that should give you some confidence as to why you should trust our forecast for the top line. Now let's shift beyond the top line and start talking about the bottom line a little bit. And to talk about the bottom line, I want to be really mindful of costs and especially wage growth. We're certainly seeing it across um, across some of the major cities today, where you've seen these new collective bargaining agreements that discuss massive increases in wages. And the reality about this is the simple fact of, hey, wages move higher for the union hotels across the market. They also move higher for non-union hotels across the market. Well, why is that? The non-union hotels don't have aren't required to compete with the union agreement. It's real simple. The biggest challenge with union operations is work rules. It's not wages, right? Most non-union hotels in union-oriented markets are willing to pay a higher wage rate to try to prevent unions from entering the market. So if the union wages are here, the non-union hotel might pay here and say, hey, you don't need to unionize. We're already giving you a wage way above, and there's no incentive, and there isn't much incentive because the non-union hotels want to keep those work rules away. But then the union wages then go here. What do you think the non-union hotels are going to do? Same thing. So you end up seeing those challenges. And I think that's what will ultimately play out over the next few years, really impacting wage growth across a lot of those major union-oriented markets. Just something to be really mindful of. These are just some examples of what the contracts in place are today, but we have a lot more coming. Overall, we expect wages to increase at a 3.3% compound annual growth rate through 2029. Property taxes are going to continue to tick higher. Insurance expenses are going to remain elevated. If in 2025, we have expenses up 3.6%. Now, keep in mind, that's overall expenses. That's not expenses per occupied room. Our occupancy is down 0.6%, and our expenses are up 3.6%. So that gives you an idea of on a per occupied room basis, we're talking about north of 4% increases. And then overall, our EBITDA growth is modestly positive in 25 and 26, ticks down in 27, and then ticks back up in 28 and 29. With that EBITDA growth forecast, we built out a cap rate forecast, which is heavily influenced by where base rates are going to be over the next few years, and the forecast for that, which you see over here, this model has a 98.6% R squared, basically points to cap rates ticking up ever so slightly. And when we put it all together, you get an overall view on values. In 2025, we estimate values are going to tick up about 3% on a year-over-year basis, fueled by primarily that 2% increase in hotel EBITDA. But over time, we actually see value growth kind of slowing a little bit from that level, looking at about 2% annual growth over the next 5 years. Why do we have such muted growth in the late stages of the cycle? Well, it's real simple. If you look at where we were in this cycle versus prior cycle, values fell more aggressively early, bounced back more aggressively quickly than the past cycle. And going forward, we see much slower growth because interest rates are much higher. Cost of capital is much higher, and as that cost of capital increases, it limits the growth in value, which is what we see here versus what we saw last cycle. And that's our view. Now, let's talk about some markets. So these are the 62 markets we issue quarterly forecasts for. These 33, we issue forecasts that go full, top line, bottom line, values, everything. And then these 29, we focus just on the top line. We look at, 2025 RevPAR growth, Maui, we think about the markets that are going to really outperform. Maui stands out as a great market. That's a market that we think is going to shine off of really soft comps from the wildfires as tourism recovers to that market. We talked about San Francisco already with strong convention calendar. The reality is, when you think about those other markets, some themes: strong Asian international demand, improving domestic leisure demand, and strong convention paces are all going to drive some of those. And the bottom performers tend to be markets that predominantly cater to corporate transient demand, have limited international exposure, or have soft group booking basis. And if we take a longer term view on RevPAR growth, our top performers tend to be those that either have really soft comparisons from 2024. Maui soft from the wildfires. Orlando had a soft year in 2024. We think that's going to be a really strong market over the next few years. Some are going through major shifts, bringing added demand to the market. Palm Beach and Raleigh are great examples of those, which are markets that we really like. Other markets with outsized exposure to leisure and strong economic trends like Sedona, Puerto Rico, Memphis, and those with strong international demand and robust convention calendars will also be strong. Bottom performers are going to be those that lack international travel demand, aren't going to see any recovery there, have sluggish economic growth, soft convention calendars, or just really, really tough comps from 2024, including Houston and Indianapolis as great examples there. And then when we look at values over the next 5 years, we generally prefer a handful of markets: Puerto Rico, New Orleans, and Orlando have been three of our favorites for a while now. We add Charlotte, Salt Lake City to our top five. Charlotte's got a great convention calendar, strong economic growth, great wage dynamics, give us confidence in Charlotte today as we look forward. Salt Lake I'll talk about in a little bit. On the bottom performers, the right side of the chart, we've got soft convention calendars. Austin, obviously, we know the convention center is closing. That's really soft. Portland's having struggling convention center basis. So is Atlanta. Difficult comparisons. Boston has had a strong year. Houston had a great year tied to Hurricane Beryl. And then you have elevated expense growth, Chicago, Boston, things that weigh on some of those markets. And with that being said, let's jump in a little detail real quickly into Salt Lake. Salt Lake's an interesting one for us. It's a market that we like a lot right now. It's kind of, from a macro perspective, poised to really outperform across the board on the top line. But it's not just about the top line outperformance. It's the cost structure dynamic that's really, really attractive there. Salt Lake City had the second highest EBITDA margin across all the markets that we track at 34.6% in 2024. That's a great EBITDA margin. They also have, when you get a margin like that, it's because you have a favorable, cost structure and favorable wage growth dynamics, which certainly play out across Utah. So those are a couple of points that stand out as, oh, this is actually kind of interesting. And then you layer in conventions, which have been down in 24. They'll actually be down again in 25, but we're still well above pre-pandemic levels. And then they're positive, pacing up 5% year over year in 2026. So bottom line here is there may be some short-term pain, but we think there's some long-term strength. Why are we so high above 2019 levels? Well, they added a new convention center hotel in late 2022. As is typically the case, the addition of the convention center hotel is translated into an increase in convention bookings and driven overall RevPAR growth across that submarket. Then earlier this week, the State House, Senate and Senate approved funding for a $900 million downtown sports, entertainment, culture, and convention district. The details of the project are still unclear, but it's likely to include an expansion to the existing Salt Palace Convention Center. That's positive. So there's a lot of good things going on there that are pretty exciting. Supply growth is muted. Only 1.3% of inventory across the entire market is under construction. Nothing in that CBD submarket is under construction today. Overall, we look at supply as very, very benign across the market. We like it. Gives us some confidence, especially in the CBD. Our RevPAR model, as you can see here, 99.7% R squared. The drivers of that model historically are over here. And the forecast for those drivers lead to our outlook going forward, which is relatively positive. And then within the market, you can see kind of This is a heat map from our LARC GIS application where you can see where RevPAR growth is going to be strongest or weakest across the market, with strongest being the darker blues, lighter being the weaker blues, and some of the projects going on that we think will impact the market going forward. And then how have our forecasts been for Salt Lake in the past? Well, in 2024, RevPAR across Salt Lake increased 2.6%. Our forecast going into the year as of December 23 was 1.3. So we were a little light, but not terrible. The other guys were negative 3.3. So we really outperformed, right? This year, we're also different than the other guys. We are cautious, negative 1.3% growth versus plus 1.9 for the other guys. Our caution is driven by the convention calendar being soft again, as well as where we see some of the other factors that are playing out across that market. We'll see what plays out, but at the end of the day, we've certainly proven to be more accurate than them in the past. And my guess is when there's that type of gap, I think we'll probably be more accurate again. But that should get that. With that, I'm going to stop. I know it's been an hour. Many of you will probably have to log off, but before you do, if you want to learn more about LARC, learn more about what we do, how we help our clients, please feel free to reach out. You can contact me directly at ryan.melliker@larkanalytics.com or information@larkanalytics.com if that's easier. These are some of the services that we typically do, but we're always happy to be as helpful as we can to our clients. And with that, I'm happy to stick around for a Q&A session. Katie Harding from my team is going to go through the Q&A that you guys have all populated and throw them at me. So with that, Katie, why don't you go ahead?
Alrighty. Do you have data on historical and forecast cap rates for the broad hotel segment, select service, extended stay, full service, versus other real estate sectors, industrial, multifamily, retail, or office?
That data is available. It wouldn't be our data specifically. We don't track cap rates across all property types. Um, but we do, there's lots of great providers that have that data. The one that I would highly recommend would probably be CoStar, but we certainly have access to that.
How much of the personal savings decline is due to the continued cost of living increase versus desire to spend more on travel and restaurants? If I remember, the wallet share, light blue line, was flat.
Actually, a very good question. Um, when you think about the share of the consumer's wallet um, being allocated to hotels and restaurants, the reality is that's the share of the wallet, not the absolute dollars. So if the wallet is, if you're seeing savings go down, we've historically seen the share of the wallet go up. That doesn't mean the share of the wallet doesn't mean to say so. If the wallet overall shrinks because you don't have as much money, you don't have as much money in it, then you're gonna, even if the share is going up, you may be looking at negative or declining spend on hotels and restaurants, um, versus the other way around. Whereas if the share of the wallet is staying static, or if the wallet size is staying static, the share increases, you'll see an impact. But the bottom line there is there's historically that strong relationship between saving more and spending less, or saving less and spending more, which is generally what we see, and the outlook is to save less, and that should be encouraging.
While you indicate that leisure spending is positive, above zero, the trend line trails off pretty significantly the past couple of months. Feels like that trend isn't positive. Can you explain a bit further why you think that trend is positive?
Sure. So I think it's a great question. So and I think you're talking about the Deloitte Leisure Travel Intentions Index. So it's positive because you're still seeing positive growth. So the growth is slowing, but it's positive growth, right? So you're going from 3% growth to 2%, or 1.5%, but it's still growth. It's not going from 3% to -1 or -2. You are seeing incremental expansion. Expansion is a good thing. That's why I would say it's positive. And if you look at where those numbers were a year ago, we are way above where they were. So that also gives us confidence.
Studies show a significant negative relationship between gasoline prices and demand for lodging, meaning that as gas prices rise, hotel demand tends to decrease. What is your view regarding future gas price trends and leisure demand?
I think you hit the nail on the head there, that it's tied to leisure demand, and it's often tied to specific types of leisure demand. Gas prices are, we actually track gas prices pretty regularly. We find it to be incredibly relevant across certain markets, and totally irrelevant across other markets. And understanding which markets are is more relevant for is based on kind of who the consumer is and what they're looking for. There's no doubt that gas prices can have an impact because gas prices can, impact where the amount of funds that the leisure traveler has to spend on other things like travel. So in that regard, it can be relevant, but at the end of the day, uh, for a lot of travelers, it's not as much of a focal point because they look at travel as being a requirement, if you will, that they need to get their summer vacation, and it's more about just what they choose to do for that summer vacation, how much they may choose to spend versus whether they choose to spend it. So we've seen it time and time again, but I can tell you we use gas prices in a bunch of our models. And Katie can probably chime into how many times she's looked at gas prices across various different cities that we look at. In certain places, it is very, very relevant. In certain places, it is not. But where it is most relevant is tied to leisure demand.
Definitely. February year to date is 3.1% RevPAR. Is that consistent with a 5.3 1Q?
Well, I think that if we've got 3.1 year to date and 1Q last year had a roughly 1% plus headwind tied to the Easter shift, I think you should be looking at north of 4. Whether we get to 5.3, we'll see.
Do you have any further info on insurance, expenses, etc.?
We have all kinds of information on insurance and expenses, but we don't share a lot of that detail because most of it's pretty proprietary.
Is 2019 a good comp anymore to inform on potential growth or tailwinds? After this period of time, is it possible that fundamentals have changed and 2019 is not relevant?
Great question. I think the answer is 100% yes, you're correct. I think 2019 is far less relevant today. We've entered a new normal. That doesn't mean to say that people don't want to understand how we compare to that still. And we constantly get that question, which is why we talk about it.
I have a question about the deck, but I know that this will be sent out, so I'm going to skip that one. Which typically second tier markets carry the most conviction moving forward? Marketplaces such as OKC, Salt Lake City, Raleigh, where new convention centers and convention center hotels are delivering? Or is it core leisure centric markets such as Sarasota, Tucson, or Savannah, or a mix of both? Thanks.
Yeah, I think it's a great question. I mean, look, if you can go back to, if we look at our 5 year RevPAR growth outlook, that you see here, you're going to see a mix of all of the above. Palm Beach is a market we absolutely love. That's kind of a leisure-oriented market, group-oriented market. It's getting a ton of corporate demand. Raleigh, you mentioned there, the new convention center. It's a home run. I think that's a great market. Memphis has a lot of good things going on with a lot of strong corporate growth, strong economic activity. It's not all downtown in Memphis, which is kind of a different dynamic there. Sedona is a market that we love, where we're just seeing massive economic shifts across that market, plus a really good core economic base. Santa Barbara just has some really, really soft comps from 2024 that stand out as giving that a market something that's particularly strong. It really does vary by market. It's not specific to, hey, the theme is all I care about is leisure or all I care about is convention center. I think there are markets where the convention center expansion is going to be a boom over the next 5 years, and there are markets where it's going to be a drag over the next 5 years. And there are markets where leisure is really, really strong, and we're seeing a lot of upside. And there are markets where all they have is leisure, and that's not enough to get them through and be a really, really strong market over the next 5 years. So I think understanding those nuances is really helpful.
Do you feel that the current administration antagonizing our allies in Europe and the Americas will impact incoming travel significantly?
Uh, I don't think it will, but it's possible it does. I wouldn't rule it out. I think it's one of those things that I think that the antagonistic approach is a negotiation tactic that he takes. And I genuinely believe that he's trying to do what he thinks is best, for the long term, and is comfortable with some of the near-term pain. If that's what plays out, I think he'll always posture it as though everything he did was amazing and perfect. And there couldn't have ever been an alternative approach that would have been nearly as good. But I do think that, he has a view and he's trying to articulate that. I also think that while the rhetoric is incredibly negative and condescending and can be brash and turn people off, I also think that uh, there are a lot of people that kind of don't pay attention anymore because they're just mute to it, benign, numb to it now. He spent so much time talking to the press, and I think there's a lot of people that just don't give him the time of day, and I think that's probably more the case than what we saw 8 years ago when he came into office, and everything he said was so offensive and really bothered so many people. I think today people just kind of ignore it a little more, but we'll see.
Why does Washington, D.C. have such strong RevPAR growth projections? Are the federal
Ah,
layoffs factored in?
that's a great question. I'm glad you mentioned that. So if you look at that 5-year RevPAR growth projection, so yes, the layoffs are factored in. But if we look at Washington, D.C. In 2025, strong, what happened in January 2025?
Inauguration.
Inauguration. And then our 5-year forecast goes through 2029. What's going to happen in 2029?
Another one, right?
Inauguration. So it's not necessarily, it's a great question. I'm glad it was brought up because that 2029 metric is inflated by the inauguration. If you strip that out, DC would be far lower.
Does the projected restaurant spending account for inflation and expense increases that will be passed over to consumers?
Yes, it does.
Someone asked if the recording will be sent out, but you can find it on our website at larkanalytics.com. And then so far, this will be the last question.
Right.
You reference group demand correlation to overall market performance consistently. How do you view McCormick Place, largest CC in the USA, ability to be successful while located in Chicago? Or is it that the lever to turn Chicago hotel performance more positive?
Yeah, so when we talk about group demand, we're focused on kind of that year-over-year growth. We look at the group demand or the convention center demand as a baseline, and then how is it growing or is it shrinking, right? Pacing data expanding or pacing data contracting on a year-over-year basis often can have a big impact on overall performance across a given market. So when McCormick Center is growing and they're generating an extra 100,000 room nights per year of demand, that is good for the Chicago market overall, especially the downtown market, even with McCormick Center just off downtown, if you will. And when it's down 100,000 room nights, it has the exact opposite effect. Um, Less focused on the absolute numbers of room nights being generated and the size of the space, and more focused on whether those numbers are changing meaningfully from one year to the next. Hopefully that helps.
And someone just said 2029, dot, 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 maybe another riot, dot, 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 question mark.
Who knows?
And right now, that's the last one.
All right, everybody. Well, thank you for tuning in. Really appreciate your time. Hopefully, you found this helpful, and feel free to reach out to us. Information at LARC Analytics or ryan.melliker at LARC Analytics, and we try to be as helpful as we can. Thank you so much. Have a great day.